All right, friends, it's Tanya with one of the biggest questions I get asked. What can I do to pay less taxes? Now, I get it, and I'm 100% with you. Why pay more to the feds than you need to? We work hard for our money, and we need to keep as much of that in our bank accounts as legally possible. There's a total misconception out there that write-offs are basically free money. I wish. According to David here, it's when you buy something for your store and the government pays you back for it. Nobody pays for it. You write it off. Alas, no. The reality of a write-off is that it is a legit business purchase that helps to reduce your profit and as a result, the taxes that you need to pay to the feds. It's still money out of your pocket. It just helps lower the amount that you have to pay at the end of the year. So let's say you make 10 grand in sales, then spend 9 on various legit business expenses. You'd have a profit of $1,000. Now, when tax time comes, instead of paying taxes on your 10 grand in sales, which could be as much as 4 grand, you'd pay taxes on your $1,000 of profit, which would be close to 400. Now, I don't know about you, but I'd give up $400 to the feds happily compared to 4,000. So, what are these magical legit expenses? Well, I split these into 3 categories: cost for stuff that you sell, cost for stuff that help you sell, and the gray areas. So, first, the stuff you sell. If you have a product-based business, this will be things like your raw materials, tools, packaging, that kind of thing. I have a client that makes candles. So for her, these expenses are things like wax, oils, wicks, jars, labels, and boxes. Now, if you're a service-based business, this section is usually a little lighter because in many cases, what you're selling is you. In my business, for instance, the only expenses I have in this section are the subscriptions that I pay for my clients. Other than that, there's not much else. Next up is the stuff you buy to help you sell. This one's a bit more universal and will apply whether you sell products or deliver services. It will be your marketing, employees, office supplies, fees, that kind of thing. So think of everything and anything you need to make things happen in your business. Your website, designers, printing, subscriptions for things like email, CRM, social media schedulers, contractors, merchant fees, business insurance, all of it. The list can go on and on. And speaking of which, in the description below, you'll find a link to get a free list of 101 costs you can use to pay less taxes. It will run through all the things you can legitimately write off. So head over and download that after this video. Last up is the gray areas. And I call them this because these are the expenses that cross over between business and personal. Again, these costs apply universally regardless of what you sell. And the 3 big costs here are your home office, your personal vehicle, and your cell phone. These are all obviously personal items, but we use them to help run our business. So we can apply a portion of these costs against our business to reduce our profits. First up, for your home office, you can totally write off these spaces. You have to be careful with things like working at your kitchen table versus having a dedicated office or studio. But at the end of the day, they're all legit. So for your home office expenses, you can claim your rent or mortgage interest, property taxes, condo fees, utilities, including your internet and home security, and your home insurance. Now, of course, you can't claim the full amount of those costs, but you have to figure out the percentage of the house that you use for your business. The easy way to do this is to count the number of rooms in your house, and yes, hallways and bathrooms count too, and then count the room or rooms that you use for your business. For instance, if you've got 10 rooms in your house and one of them is for your business, you have 1 of 10 or 10% of your house used for your business. And you guessed it, that means you can claim 10% of all of those home expenses as your home office. My unwritten rule is to keep this around 10 to 15%. Anything above this, and you may get flagged for an audit, that doesn't mean that you can't claim over 15%. Just that if you do, make sure that the spaces you're counting as your business are 100% of the time dedicated to your business. So it's not like your bedroom or your kitchen table, things like that. Next is your vehicle cost, which works kind of the same, regardless of whether you have a corporation that owns the vehicle or if you're sole prop or own the vehicle personally. You can only claim or write off the portion of the vehicle that you use for business purposes. Now, the ultra legit way of doing this is to have some kind of mileage tracker where you allocate every kilometer you drive to either business or personal. And then at the end of the year, you total up your business kilometers and your personal kilometers. And like with your home, you then get a percentage that you can use to write off. Now, if I just sent you into a tailspin, panicking that you didn't track anything over the year, it's okay. I have a few things I do to try to come up with that number after the fact. One option, and what I did for years, is to go through your calendar and use Apple Maps to figure out where you drove throughout the year. So I personally plan everything in my digital calendars. So I would just go back, whether it was the 3, 6, or 12 months of the year and figure out where I went and use Apple Maps, put in the to and from, and get the kilometers there and back and just add those up. Option two is, just guess. Super scientific, I know, but you drove places, so we just need to not get too greedy. I like to have the business versus personal to be around 25%. That seems to keep things under the radar. Lastly is our phone. We run our businesses on our phones, so we for sure can write off some of those costs. It's generally a good idea to allocate a portion to personal, but that's totally up to you. Now, let's talk off the record, because let's be real, the more expenses we have, the less taxes we pay. So it's totally natural to want to slip in a few non-business things into the mix, but you got to be smart about this. First off, some rules. Every expense you claim in your business needs to have a receipt, bill, or some kind of backup to support that cost. And no, a bank or credit card statement doesn't count, unfortunately. The feds want to see a real receipt that shows the details of what you bought, who you bought it from, and the total and the taxes that you paid. You only have to show these receipts if you get audited, so you have to keep them safe. Which brings me to rule number 2, which is more like my adamant advice. Digitize your receipts and save them where they won't get deleted or lost. So think the cloud. I promise if you get audited, it will be in year 6 of the 7 years they have to audit you. And the chances of those little pieces of paper being lost or thrown out or just faded to nothing are almost guaranteed. I've had it happen to me, and it cost me almost 10 grand in taxes because I couldn't prove my expenses. I've been digitizing everything ever since. So knowing that, here's how to be smart about adding things to your write-offs that are more beige areas than gray. Number 1, make sure the receipt shows something that could legitimately be for your business. I had a client that would use their business discounts and money to pay for shipping for their family's gifts at Christmas. Personal? Yes, totally. But really, they ship hundreds of things each month, so what's one more Canada Post receipt in the mix? And another client, though, that slipped in a Michael's receipt that had a bunch of canvases and painting supplies. The problem was they ran a clothing manufacturing business, nothing related to painting or artwork. That one could be a little harder to explain if they got audited. Number 2, tie the expense to something relevant. I had a client once try to claim their regular Botox treatments, rationalizing that they needed to look good for their customers. In my humble opinion, hard no. Same with your regular trip to the salon or to get your nails done. This is personal, and you're going to be hard pressed to convince the feds otherwise. Now, what I do consider legit is getting hair, nails, makeup done for something like a photo shoot, a specific event that's full on for your business. Speaking of photo shoots, the last thing I sometimes see is clients that will buy props or accessories for their brand shoots, and after the shoot, they'll use the items personally or just return the item. This can cause a dilemma for many, and yes, of course, if you return the item and get your money back, technically you should remove the expense, but, well, who will know? You decide. All right, friends. That's it for this episode. Don't forget to grab the free cheat sheet, 101 costs you can use to pay less taxes. I've dropped the link in the description below. And if you have any questions about write-offs, comment below or send me a message on our website. You can find the link down there as well. Thanks for watching and see you next week.